Welcome, my name's Adrian, and today I'm taking you through our October global market review and what it means for positioning into year-end and early in 2026. It was a constructive month for equities overall, but beneath the surface, performance was nuanced with dispersion across regions, sectors, and styles shaping the outcomes. So global markets delivered solid gains in October, supported by resilient earnings and improving liquidity. Yet dispersion remained significant. Investors favored long-duration growth, strong balance sheets, and structural themes such as AI and automation. In contrast, areas exposed to softer global trade, tariff uncertainty, and margin pressure underperforms. This widening gap between the quality growth and cyclicals continues to define market dynamics. Let's look at the United States. The US remained the anchor of global equity performance. The S&P was up 2.3%. The Dow gained 2.5%. The Nasdaq advanced 4.8%, making its seventh straight month increase. Earnings revisions showed strength in tech, automation, and communication services, offset by downgrades in energy and materials. Leadership stayed concentrated in mega caps, pushing valuations to roughly 22.5 times forward earnings. The Fed's 25 basis point cut provided support, but Chair Powell signaled easing will be slow and shallow. With the equity risk premium near decade low, target stock selection remains critical. Europe was steady, supported by inflation easing to 2.1%. The CAC 40 gained nearly 3%. While the DAX was only up marginally 0.3%. Structural challenges persisted: subdued industrial output, restrictive policy settings, and fiscal fragmentation. Defensive, such as luxury, healthcare, and consumer staples outperformed, while autos and chemicals lagged. Despite this backdrop, Europe trades at a significant valuation discount, roughly 30 to 40% to the US, offering selective opportunities but lacking broad catalysts for a re-rating. The United Kingdom, the FTSE 100 gained 3.9%, reaching a new high. The rally was driven by energy, mining, and globally diversified companies benefiting from stable commodity prices and a softer sterling. Consumer-facing sectors lagged as households continued to face cost pressures. Inflation remained sticky, limiting the Bank of England's flexibility and keeping valuations sensitive to rate expectations. If we look at Asia and emerging markets, but when we talk Asia, we exclude Japan, performance across Asia and emerging markets was mixed. The Shanghai Composite rose 1.9%, while the Hang Seng declined 3.5%. India, Korea, and Taiwan outperformed on stronger tech demand and improving manufacturing PMIs. Emerging market equities still trade at about a 30% discount to developed markets, but widening growth divergence means country-level and sector-level selection is increasingly important heading into 2026. Now looking at Japan, Japan was a standout. The Nikkei surged 16.6%, hitting new all-time highs. Sentiment improved following political clarity, ongoing corporate governance reforms, rising wages, and a strong industrial production. Japan remains one of the few markets where earnings momentum, valuation, and policy conditions are aligning positively, supporting continued investor interest. South African equities also advanced. The JSE All-Z gained 1.2%. The financials rose 7.7%, property climbed 6.3%. However, resources fell 10.5% on weaker commodity prices and Chinese demand. This widening gap across sectors underscores the importance of style-aware and sector-aware positioning. Investors who remain selective, tilting towards resilient domestic sectors while managing exposure to volatile resources, will be better equipped to navigate South Africa's two-speed reality. From a strategic outlook perspective, there are three broad themes which will shape markets heading into 2026. One, narrow leadership in the US increases risk and demand selective exposure. 2, monetary easing will be gradual, keeping rate volatility elevated. 3, growth divergence is widening, with Japan accelerating, Europe stabilizing, and emerging markets increasingly two-speed. October reminded us that markets can rally even in difficult conditions, but the quality of a rally matters as much as the magnitude. Gains were broad, yet leadership was narrow. Sentiment improved, but risks do remain. The global economy is entering a mature disinflation phase. Monetary easing is underway, but constrained. Volatility will stay episodic, and opportunity is increasingly idiosyncratic. Our focus is balanced, investing where growth and earnings justify valuations, while reinforcing resilience through defensive equity quality, selective duration, and disciplined credit exposure. With easy gains behind us, our performance will depend on active, thoughtful portfolio construction, diversification, quality, and the right mix of patience with tactical agility will be key to sustaining long-term returns. Thanks for watching, and we will continue to keep you updated as conditions evolve. Good day.